Hello everyone and welcome back to another video. Well, you're all probably asking the same question. What just happened to the markets and what do I need to do and should I be scared? Is this the beginning of Michael Burry's forecasted crash and forecasted end of the world? Or is this just another pullback in the markets? In today's video, we're going to be taking a look at the S&P 500, Nasdaq, Bitcoin, gold, Tesla, IWM, Dow Jones, and more. There's a lot to cover and there's heaps of great information in this one. Stay tuned, guys. Okay, well, here begins our recap of the market for the close of the 19th of July, 2021. And we do this to get an understanding of where Wall Street's money is flowing. When we understand the flow, it's one of the big data points that we can then use to help us make better informed decisions about which stocks and which markets we want to be trading in and investing in. So here's the heat map, and straight away you'll notice it is a sea of red. Very little green here on the day. Apple down 2.69%. We had the financials, which generally is a very heavy hit sector during red days, down hard. And then, of course, we had energy as well, moving to the negative side. Now, when we go and have a look at the indices themselves, you'll notice they all started and moved down earlier on, hitting some key technical points that we'll be talking about this video, some really great levels there. And then by the end of the day, we actually saw a very nice rally. Now, we also saw a rally into the lunchtime session, and this is pretty good precursor of what Wall Street's true intentions are. And while they dumped it down after that point, they then moved it right up near the close. So this really shows that while everyone else was panicking, Wall Street was acquiring positions, at least through that middle to close session of the day. Remember, the retail hour, being the first hour, is not usually a true intention of what the market is going to be doing. What happened on the actual sectors that we watch here? Well, biotech was the leader. It's in its kind of like strong sector performance months at the moment, which we've been discussing since obviously June. And then we've also got XLP, consumer staples, healthcare, which is also in a strong month, and technology coming back in. It was really financials and energy that were getting affected the most. And this could be due to a whole bunch of different reasons. I will also just let you guys know that, of course, we do have earnings season at the moment. This is important when we think about Netflix coming out. We think about Coca-Cola, Johnson & Johnson, Snap, Twitter, Intel. All of these are going to really drive sentiment. Will they perform well or will they perform poorly? Now, for anyone that also hasn't been watching our videos recently, I just want to remind you that last week we were discussing this point, and I think this still cannot be understated. I had a look through the data, and I think it's pretty good. So this Martin guy, he basically came up with this idea of the Russell 2000, new highs and new lows. And I've always believed in the Dow Jones Transport Index, and also, of course, you've got the Russell, are a good indication of a market precursor to a correction or decent move negative. And we'll have a look at that soon. But basically, he said that there's only 3 times that he's ever seen this particular stat here, which you can read on the screen, new lows and new highs for 2 days. That was 14, 15, 18, and all of them led to at least a 10% lower over the next 3 months. Now, does that matter? Does that mean it's going to happen tomorrow or anything like that? Absolutely not. But it is something that we want to keep in the back of our mind when we're trying to figure out exactly where we want to invest, where we want to buy the dip, and where we want to trade. Super important we understand the differences between those ones. Now, they're all coming up with excuses. We know Wall Street likes to use excuses in plain sight. So what were the excuses that the media is telling us? The Delta variant is getting a lot of attention right now, and it is an explanation of weakness. It's not a new thing. We've known about this for quite some time. So again, it's just that now all of a sudden it's a massive problem. You can agree or disagree with that, but generally this is not, this is more of an excuse than anything else. Then another good reason is that we're really at the peak of everything. Peak valuations, peak growth. Again, we all know that if you're making all-time highs, of course, you're going to be getting peak valuations. And then the third thing, which I think is probably valid, and this is actually what caused, in many ways, the 18 kind of crash in the markets or correction in the markets, was the US-China relations. This is probably one that I do think is really important to the markets over the longer term. And it's probably the only reason that I would say is relatively true out of all 3 of these. The market has known about all of this stuff, and it is not new, I know that, but this is the excuses that they use. And remember, it's all about seasonals, it's all about understanding the data and putting together the data, the technical analysis, and the fundamental analysis together into one big picture. That's what you want to be doing. You want to be trying to draw a conclusion from as much great information and cutting out the crap as much as possible. So let's have a look at the dollar index here to start with our technical analysis. And straight away, I will say this, it is looking pretty good. We've now moved above, of course, the 92.80. If we go to the daily here, let's see how it's been moving through it. We just got to close above that. Then it's come down and bought off it. This kind of shows us that there should hopefully be some strength here in the dollar index. It is above the high. It came down very aggressively yesterday, and now we're in a little bit of a trading range. So I think if it gets past this little resistance up here, we should be looking at some decent strength coming out of the DXY. And then, of course, that moving towards the bull side. Very interesting times. This usually means risk off in the market. So the stronger the dollar index gets, the more likely that it is a truer correction in the stock market occurring. Let's now have a look over in gold. What's going on here? Well, gold is also at the peak. 18, 17, 18, 18. This is exactly the level that we want to see broken for gold to resume its movement up to the 1843, 1845 zone. It's had a very torrid kind of last couple of days of trade. We've seen some false breaks where we got a nice big bullish hammer, no follow through, which we've discussed is super important in the markets. And then it got closed underneath. That led right into the support line here, which is, of course, our red highlighted zone. And now we're at the resistance again, looking to break through. There will be some day trade opportunities from the perspective of technical analysis if it breaches through this zone. And, of course, you can go in there and take a look at that. Gold looks okay for now. Then we have 20-year bonds. Now, we talked about how we expected 20-year bonds to actually outperform the S&P 500 for the month of July, and it looks like that is actually occurring. Bonds are on a tear, but they are going to hit a resistance soon, and that's this 155 level. So I think we should be watching bonds. If you're in it, congratulations. You got 2.19% out of it yesterday, which is pretty good from bonds perspective, and bonds are moving into the resistance. So I expect these supports, this resistance to become resistance again, and for that to be like a turning point in the market in terms of what does end up happening after that point. Let's move over now to Tesla. What's going on with Tesla, guys? It's on support. It's bounced. It actually did pretty well yesterday. It's up 0.31%. So the resistance being 630, the support trend line, and then, of course, the support horizontal, they all worked out. And I'll say one thing about trend lines, and this is how I see it anyway, is if a trend line is breached with a gap, so let's say it gaps underneath the trend line, and by the end of the day, it bulls back above the trend line, I don't consider this a break on the daily. Now, some people will, I don't, because I've seen a lot of times when it does this, it actually tries to move higher. Now, some people will say, oh, Tom, it's a retest from the bottom up. I usually prefer that it's like a red candle and then it retests from the bottom up and then comes down. So just be warned that when a market gaps underneath, which is, of course, the difference between the close price the previous day and the open price, and then it fully bulls back into the actual trend line itself, I don't see that as a negative towards the actual stock. And in this case, I hope it does go up, and I hope it trades pretty well for people and moves through to what you need. If you have a look on the 1 hour, it does look precarious. Of course, this is the trend line. This is the resistance that it's at. So we'll have to find out how it ends up trading. But yeah, exactly this point here, it's at critical. Currently, the market is basically flat into the open. So if it holds around there and Tesla can get through, then that's great. But if Tesla closes back under 621, the bears have got control of this market and they will start to really push this thing, I believe, a decent amount lower. In fact, the next level for it is going to be somewhere around 560. So that won't be good if Tesla does move down through that level, unless you're shorting. Let's have a look at the Dow. So the Dow opened and closed pretty much the same place. It basically opened and closed on the support line of the trend line. This is a very consistent one from January into March, into June, into July. If we breach and go underneath this point, I think that that's significant enough to say, okay, we really are in a bear market here from the perspective of the bears have got control and the bulls have lost control of the market. This is the first or one of the precursor signs that I'll be looking at. So we've got bonds going up. We've got dollar index looking strong. We've got the US 30 on the mega support, and it's all looking incredibly precarious right now. IWM, the Russell 2000, we mentioned at the start of the video, this is something we look at to show us weakness in the economy. Why? It's the smaller cap companies. What's going to get hurt most? It's not usually like a big company like Apple that's going to be hurt. It's the smaller companies. This is where, when you're seeing an expansion of the economy and or expansion of the markets, generally speaking, the Russell 2000 is a very good precursor to showing the robustness of recovery. So think about this. We went from $100 effectively here, up 64% and hit this all-time, almost all-time high over here at 164. Then when everything started firing late November and we saw that massive second run in the markets, the Russell 2000 performed incredibly well. And this is because everyone got very confident. People started taking positions. They started looking at the smaller companies and figuring out which ones they want to be in. They stopped really looking at just the big companies and saying, okay, we want these. And they said, whoa, we believe that the worst is over. Let's invest in the small ones. It's a really important point, and you should always think about that in terms of why we look at this chart. So support, and now support again. Weekly close was horrible here, and this is the first time it's closed underneath this massive amount of buy weeks. And you can see here we've got indecision at the lows. So tomorrow, in terms of the trade that we're going to have, is going to be very important. Do we close underneath this 208 level? If we do, what happens? I think that we begin the beginning of a decent short, because we've got a massive range here in IWM. And if we close above this level, then hopefully that means we've actually done some recovery. It's critical. You can see it here. If you've got a range like you have here in IWM and you take that down, this is predicting like a 185. And a 185 is a very significant amount of move for this. Notice as well, the daily 200 is coming right up. So if it hovers around here, hits the daily 200, and then breaches underneath that, how significant is that? I would say very significant, considering when it's breached it previously. Look over here on the left-hand side, 1, 2, 3 bounces. And then when it did get through, it began that 18 fall. It kind of smells in some ways like 18, trade war tensions, deglobalization, and other problems as well. Imagine if that happened again. People may not be prepared necessarily for something like that. Let's move over to the other markets. We'll start with the S&P 500. So I think with S&P 500, we always want to use SPX or a code like this. This shows us the true market trade and the true market actually during the day rather than just the futures. And you'll notice the 50 exponential has been the key level. Just like the Dow's on support, this is on the final boss level of support. And usually you will see a bounce off this zone even during a market kind of crash. So if a market's correcting, it'll usually go down here, bounce up, maybe hit the 20 from the top down, or from the bottom up, sorry, and then we move again. And what this does is it creates our fabled lightning bolt. You've got your peak, your trough, your lower peak, and then you get your lower trough, and this signals your further correction. Now, I've talked about 10-15% being quite possible. If we actually take 10-15% from the top, it gets down to around this daily 200 from about 11% perspective. This would be a pretty good target zone, and a lot of that's got to do with what our expectations would be. And basically be bringing us back down to the 50 exponential moving average on the weekly, and we haven't hit that for quite some time. But again, let's look at the left. What's the left telling us? 50 during a correction, 50 during a correction, 50 during correction, 50. Then we get a deeper one through this point here. Then again, the shorter ones have gone to the weekly 50. Throughout this entire rally, guys, I just want to mention that again, we have not seen a 50 exponential weekly. It has been so aggressive and so fast that we haven't seen that. So when eventually we do get a correction, which it does happen, maybe happening right now, I actually kind of expect the 50 exponential. I just think it's a healthy market pullback. And if the market doesn't do that and it goes off and booms into the sun, guess what? It's even bigger problem, because while you might be thinking, no, Tom, I want it to go up there, and I totally feel you, that's making the money right now, it's good. If it does that, we are in serious problems. Or it's already extended, which we know. It needs to have the normal healthy moves. If it doesn't, well, we could be in some problems. Let's move over to the QQQ. Similar to the others, it's kind of hovering around a zone. You'll notice here on the daily close, it kind of opened underneath the 20, went down, moved up, kind of made a bullish looking hammer here candle, and we'd want to see follow through to fill the gap here. So again, there's a decent case for all of these indices to say support, 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 fill the gap, maybe then move down, And if it makes a new low, of course, for it to be quite negative on the market. So let's move over to the second last market that I want to discuss. And that is, of course, XLF. This is the bank sector. And I wanted to discuss this because I feel like everything always starts with the banks. The financial sector always is the beginning of the end in terms of most pullbacks. It's the one that gets beaten. It's the one that weakens the first. And whenever you're looking at, let's go back in here into 18, whenever you're looking at bad things that happen, the financial sector starts to weaken. You can see through the whole year, it breaches below, and this kind of begins that really bad period that we had through that October zone. See how it breaches here? I always think that this is the sector that leads and then the rest come with it. Now, this is not a healthy looking financial sector, but I wanted to bring up JP Morgan, which I did on the stream last night, 1 hour before the market opened. Guys, can anyone tell me in the room below, let's put in the chat if you spotted this one right now before I say it. I'll give you a couple of seconds. Can you spot the pattern that is on JP Morgan? I'll give you 2 seconds here. Let's see if you can. All right. Well, I've given you just enough time. Let's see if you've written it down there. We've got left shoulder, head, right shoulder. Obviously, this is a incredible head and shoulders pattern, and it actually just closed right around the level of the neck, and you could almost argue it's on the closure below. This type of thing usually precursors bad stuff in the markets. I mean, that is like a literal head and shoulders that's predicting that JP Morgan should go down back to about 128. Let's go over to the weekly here and see where that is. That is such a huge pullback. Now, when you're going bearish in a market, you never, ever, ever usually take the technical analysis to the correct level because the market is optimistic. The market is generally bullish. But of course, this movement here on JP really is signaling to go back to the 140, isn't it? I mean, at least that resistance, support, 50 exponential. I mean, there's a lot of things saying, I'm not very big fan of this. And we've even got the rejection wick over here, which is, of course, a shooting star. It looks very, very clean and very bad. If I was looking at this chart, I certainly would not be buying the banks right now, but that's up to you and obviously your own decisions. Quickly move over here to Bitcoin, another one that's weakening off. You can see it's at support, but looks terrible, unfortunately. I feel a bit bad for Bitcoin hodlers. This is not the type of market that you want to see. I think regulation and all that discussion is not good for sentiment on Bitcoin right now because people have concerns over Tether. We'll continue to watch the situation, but in essence, the weekly closed underneath the 50, and that's leading to further sell-offs. Good luck, everybody. I wish you all the best, and of course, I hope you have a successful couple of trading sessions and a successful investing session moving forward. Remember to subscribe if you like videos, and we'll see you in the next one. Bye for now.